everyone, welcome to another edition of the Buddy Study Group. And what we're going to be doing today is reviewing what I believe is one of the most impactful updates and changes to our sales tools that I can remember. And I've been here since we've started putting out sales tools of all sorts, all shapes and sizes. So, you guys who are on the calls very often or are working very closely with us know that we love calculators and we have all different flavors of calculators. But we've been very focused on our group Quick Quote calculator, which essentially, at its inception, is designed to give you, representative pricing and value for group products at your fingertips, but generally only for one product at a time. Very recently, we updated the tool to be able to compare group products to different scenarios, right? Like self-funding, comparing even to individual long-term care products, and the cost of care. But this recent update is going to allow us now to, I don't know this for a fact, but I believe it's probably the first calculator of its type that can compare two group products side by side. And in QAing this tool, in going through it with our development team, I was immediately able to grab a lot of really impactful insights just from testing and trying to break the calculator. So, what I hope to do today is to take you through the tool and go through a number of different kind of comparison case studies to give you an idea of what you can learn by going through this calculator. And really, I mean, you may have this in mind for specific groups. You may come in and use this calculator and say, okay, well, there's really two finalist products we're looking at, and I want to kind of break them down from a pricing and value perspective. But you can go in there and just play around out of curiosity and really come away with a lot of good insights that I think will help round out your knowledge about these products. So that's really what we want to do today. Feel free in the chat, beyond just questions, if you want me to pull anything up on the projector screen here and give you all, an idea or a specific kind of comparison that you want to look at, feel free to give me a shout. But I'm going to pull this up now, and we will take this thing for a spin. So, our group quick quote, it has changed a lot, and it's changed rapidly over the last year. I think it came into existence at the end of last year, looking very much like our original Excel versions of Benefit Buddy, and it has gone over a number of different makeovers and facelifts. So this is where we're at today. I can also outline a couple of improvements we're still looking to make into 2026 that will be really, really impactful. But the biggest change this tool's undergone is you can hit this plus button. By the way, on the sidebar, Sales Tools, Quick Quote. That's how you get here. Make sure that the tab is set to group. But this button right here is the bread and butter of this tool now. Compare your plan, right? It is great to be able to know pricing and value at your fingertips, even greater when you have a frame of reference, be that another product or one of the scenarios that you can populate here. So you'll see when you hit compare your plan, group product will be the default, but you can compare to a number of different scenarios, individual, hybrid life, so life plus long-term care, individual, traditional long-term care. You can compare to the cost of care and self-funding. But today is all about this brand new feature of being able to compare group products. So I want to give you an idea of the range of motion that this tool has, number one, but then I want to really just peel this away and come out with some interesting insights here. So you can see the default will be to mirror image at first what you are already looking at on the left-hand side chart. So we've got the left-hand side, right-hand side. The right-hand side is only going to be modified with a death benefit or a plan design, okay? Since we're dealing with just life hybrid carriers right now, it's just going to be death benefit and what plan design do we use here? And we do have a number of new plan designs that I'm going to introduce as a part of this. So this is a huge update, lots to unpack. Feel free to ask questions. Um, but you can compare one plan, uh, you can compare the same plan to itself at different benefit levels. I think this helps a lot in individual employee consultations, right? Where somebody is kind of deciding, do I start with something small or do I try to purchase all the way up to the guaranteed issue maximum today? And this is a really easy way to show that we're kind of retaining value as we buy up to higher levels, right? So maybe you're even dealing with an employer funded case where this employee has been funded a $25,000 death benefit, and you can get an idea of what cost will be covered there. But understand if we're at 100,000 guaranteed issue level, you can understand how much that may be to buy up, right? 175 minus 44 is the overall premium you'd pay, right? It'd be $141 to get up to this benefit level. If that seems too high, we can kind of walk them back down incrementally to get to that. So if we wanted to look at, whoa, if we wanted to look at 75,000, it'd be 131 minus that 44. If we wanted to look at 50,000, it'd be 87 minus that 44. Now you're seeing also that the pricing is quite linear, right? It's about double the premium to go from a $25,000 death benefit to a $50,000 death benefit, right? So there's a lot of different insights you can grab just from this. You're doubling your monthly benefit, you're doubling your total premium outlay, but you are also exactly doubling your benefit. Okay. So even seeing that we go between these different benefit levels and the insurance multiplier is the same, we're getting the same amount of benefit per premium put into this plan. No need to really belabor this that much. We can compare two products to each other as well. But I just want to run through some of the plan designs because we're working on retooling the way that we describe these plan designs. I'm going to help you read between the lines a little bit. For the Allstate Whole Life 6% acceleration, no inflation, that is essentially all of your states outside of California and Utah that don't have that 5% inflation rider on it. So any other of these states that has the Allstate Whole Life product, this is what you're going to look at. This is the California and Utah specific plan design. Sorry, I had to let somebody in with the 5% inflation protection on it. This is Allstate's term life. Okay. It's about 20 plus another small handful of states that this product's available in. So use Product Buddy to help you for now see if the Allstate term life plan is available in your state. And then the Allstate term life also has a 5% inflation provision on it. Sorry, we got people at the door. So if you have a state that is eligible for the 5% inflation protection, this is going to work a little bit differently than the California and Utah plan design. We've talked through it before. Essentially, when it comes to the inflation protection there, it's only inflating the amount of long-term care you can accelerate. So think same size drink, bigger straw. We're able to access more of that monthly benefit, but that monthly benefit period essentially shrinks. So think you can accelerate up to say a $10,000, $15,000 monthly benefit, but you'll be taking that over a couple of months as opposed to 17 plus 17 with the extension rider. We also have, due to tons of popular demand with Unum's most recent announcement that new hires won't be able to access Unum plans starting February 1st of 2026. We have Unum plan designs in here. Just two of them. You may have groups that have more customized Unum plans, but we wanted to be able to show some of their representative pricing. So we have their 3-year plan with no inflation, their 3-year plan with 5% compound inflation, so that if you have groups that are trying to make that decision, you can do a little bit of a pricing analysis here, as well as in our census quote. It was recently added to the census quote tool as well. We have Chubb's plan designs here. So their EOB1 plan is just a pure 25 plus 25 month plan. Their EOB2 is generally for groups over 2,000 lives. Generally something you'll need to request of Chubb, and is kind of by their discretion to a degree. This is essentially a 75-month plan. So 25 plus 25 plus 25. And then we have, let's see, we have their 4% acceleration with no riders. This is generally either for smaller groups or impossibly large to administer groups. This is a very stripped down version of Chubb that we've done with a couple of limited partners, but these are generally for uh, insanely large accounts. Think big payroll administrators. A simplified version of the plan that's easy to administer, easy to enroll in. Transamerica, we have both of their UL10 plan designs. We have their high cash value plan design that is a bit more costly, but projected to remain in force longer. And then we have their high face amount, which tends to be a bit cheaper, only projected out to, I believe, it may be age 80, 85, around there. So less of a in-force projection, but a little bit cheaper as well. And then we
Yeah,
also,
just to add a little detail, because I was on a call with them today. The high face amount is to age 80, like you said, and the high cash value is to age 100.
okay, okay. I didn't want to say on the high cash value. I thought it was into the 90s, but we can confirm 100, 180. So, or 180. So the pricing is essentially going to be a little cheaper if it's projected in force to age 80, and a little higher to age 100. Transamerica Transelite is going to apply to 3 states. So we're going to be breaking this down into one more plan design for Transelite because there are only 3 states where we're primarily using that, and that's because UL10 is not available in those states. This will apply to New York, Vermont, Virginia. But Vermont and Virginia actually do have access to some of the extra riders like extension of benefits and or restoration of death benefit. New York does not have access to those riders, but this is the primary product for Transamerica in New York, Vermont, Virginia. And then we have Trustmark's Universal Life Events, their flagship UL product, and their Life Plus Care, which is their term life product. So we have a number of plan designs here. And Mark, before we go into some of what I think are the most illuminating comps, anything to share on this?
Yeah, I want to kind of give a bigger picture remark. This is kind of the version of how we think about the value proposition of long-term care with the insurance multiplier.
Hmm.
It doesn't mean that every group is buying long-term care for this reason, though.
Yes.
And what we see a lot with these group products is people have no coverage at all. And the ability to get even an acceleration with guaranteed issue at a low price can be quite valuable to them. So we do have another, I'll call it design on Benefit Buddy, like a simplified design that we use for some of our enrollments that doesn't show the total paid premiums or the insurance multiplier at all. It's more of a simpler quoting tool where you have the price and the benefits, and that's it. Because the purpose of why they're buying this is a little bit different. So when I think about the Trans Elite in New York, as an example, you'll see, kind of the leverage, right, is lower on the right-hand side there. If you're thinking about this only because of the leverage and your client is buying it for another reason, affordability, guaranteed issue, you might be missing the mark in how you present it. So I think it's important to not get too myopic on only looking at, one facet of why people are buying it. Also think about getting them a starter plan, getting them in the door so you can build more coverage later, maybe even to add individual coverage to fill that gap, etc. But that's the most common mind shift I've had to do because I'm, a long-term care specialist on the individual side for a long time, and I have to realize that it's okay for some of these plans not to have inflation. It's okay for some of them to end at 100. It's okay for it not to have the extension rider because the purpose of why we're doing it is so that they get educated, they get something quick, easy, affordable, and it doesn't preclude them from adding more coverage to cover that gap, right? You're not able to not get that. So I just wanted to again make sure people don't forget that because you will leave a lot of clients and do what's in their best interest, off the table if you're too one-minded about how you think about this.
Yeah, and that's a super important thing to bring up because I think every single person on this call struggles with that thought at some point or another, including us, every time. And you and I have conversations pretty often where we have to kind of peel back that individual long-term care specialist mentality that we've been ingrained with and say, look, it's this or nothing for this group, right? So we have to show them that they're still getting valuable coverage. And when we compare here, even just like looking at the Allstate plan, yes, you end up with a little bit higher monthly benefit. Your total benefit's higher. Your insurance multiplier is higher by a pretty big factor. But you look at the costs and you say for a 45-year-old employee, this is half the cost. So an incredibly affordable plan that's going to get somebody access to something that they otherwise would not have access to.
Yeah.
That can kind of change the way that you think about this plan, right?
Yeah. The other kind of aspect of this is the carriers themselves, as you work more with them, and we've done a lot of enrollments now with a lot of these carriers, their customer service may be really poor. And that's a big part of the success, especially with HR having to be the one to manage all of that. There's some brokerages, very large companies that we partner with that won't work with certain carriers at all because their customer service isn't good enough to meet the standard, that they want to have and the brand that they have, to be a concierge. So obviously, we've chosen these carriers because they have market leading products. We've enrolled a lot with these carriers so we can create a process that's streamlined, but we will choose carriers when the decision is close based on who's going to give them a better experience. So it's not your only factor, of course, product. You also have to think about can they follow through on their promises, right? When we talk about carrier strength, it's the same kind of thing. There's a lot of dimensions to this. So I just don't want lead people to believe that, okay, this is the best value, the lowest price, that's it. No, we also want to get into, are we going to be able to deliver a great experience for them? Because you have to have a high
100%.
quality company behind there to fulfill those promises.
Yep. Couldn't agree more. Mark, I wrote down some comps that I just thought were super interesting as I was going through this. We were QAing and getting this ready for release. I'm going to read some out. You tell me where to start. What's most interesting to you on this list? So I have just the base Allstate versus the 5% plan design. I have Unum 5% versus Allstate 5%, which I thought was also an illuminating one. We have Allstate versus Transamerica, kind of comparing our small group carriers. Allstate's term versus their whole life, which has been quite a hot topic lately. Chubb versus Trustmark to kind of compare our large group carriers, and then Life Plus Care versus Allstate's term to 100.
It's a long list, Jason.
It is. There's a lot of insights we can
Uh,
pull out of this, and unfortunately, we only have 45 to 60 minutes.
yeah, I think one person in the chat, I think it was Raymond, had said he got a Unum case. So
Okay.
for that reason alone, let's start there. It's kind of illustrative because you will see it's not going to be completely apples to apples here. And you might see the no inflation more, but that's fine. We can use the 5%.
Yeah, let's get something that is kind of close and kind of round numbered. Of course, since we're dealing with the traditional
Sure.
plan, we're not going to end up with very round numbers here for max long-term care benefit, right?
Yeah.
Um,
Yeah. I might
what?
do that. Do the no inflation just because this is hard for me to
Sure.
do without. And then
We
yeah,
could
probably
also
let's
we
do let's do because of the states, let's do Allstate term life
okay.
versus the Unum no inflation.
Okay.
That's the most common comparison I do for Unum, and then Unum no inflation. The 5% is only usually buy-ups. This is usually the base plans.
Okay.
Okay, so this would be an example. And lower the death benefit because I'm not comparing the total benefit. I'm comparing usually the
Sure.
monthly benefit. So
Okay.
let's do 50,000. Okay. So this is probably a pretty common scenario, Raymond, in terms of you have a Unum group, and usually we'll ask for the invoice because that will actually tell you how much they're paying for their current base plan and how much they're doing also on the payroll deductions on the voluntary side. And one of the things you'll notice here is on the right-hand side with the Unum, you have a price that's lower than on the Allstate Term Life side, right? This is before there's any rate increases because they haven't done rate increases on these base plans in a lot of cases. We fully expect for them to do rate increases in the future because number of reasons, but they just reinsured their business to another company that's probably going to require them to do that. Obviously, they're not taking new employees in February. It's a big signal like we've seen time and time again, right? That they're going to start, making changes to their in-force book. When we present this to clients, you might say, well, why would they want to move to the new plan? It's because the new plan has guaranteed premiums. Number one, you have HR, they're going to have to decide what to do to pay those rate increases. And if they can get into a plan where the rates are not going to change, that in of itself is going to be worth it. And the reason I say that is look at the $53 absolute price. And let's say they have 20 employees, it's $1,000. They're going from $600, $30 a month to $1,000 a month. A lot of times that difference is not that big of a deal to them.
Right.
Okay. It's not about matching the price they're paying. It's nice that they don't have to have a big, call it, increase to what they're currently paying. But the fact that they can increase it at $400 extra a month and have guaranteed rates, sometimes that's just a slam dunk. And that's actually what we've seen from these groups we presented to. They're like, that's a no-brainer. If I could get the Unum plan and pay twice as much with guaranteed rates, I'd take that. So why am I not taking this offer, which is giving me guaranteed rates and is solving the main issue that I want to have, which is stability in what the company is paying for? Now, the voluntary side, which is the other piece to this puzzle, I think also has a good story and messaging around it. It's portable on the Unum side. You're not taking it away from employees, even if you move the funding over to the new plan. They still have the option to keep their policy, and we encourage them to keep their policy, as you know. And they could even add this policy so they can actually get more coverage. So there is a lot of more flexibility, even if you move to the new plan. They're not losing options, they're gaining options. So there's a lot of different ways to do this. Again, when you kind of get into it and you talk to HR, you'll learn this. We have one group that's looking at just taking the new hires and funding them and keeping the current hires that they're funding in the old plan, then just waiting for the rate increase to happen and deciding later, right? Kicking the can down the road. But a lot of the
I'm
group
working
are
with
just saying,
several
let's just
groups in
make a
that. And
switch for everybody.
yeah, sorry to cut in, but I'm
Yeah.
working with several groups under that same mindset. I actually do not want to move my employer funding from the Unum plan, or I don't want to yet. But what I do want to do is continue that culture of offering great benefits to my employees. I may only have anywhere from 7 to 20 new hires that I can fund on the new plan if we're looking at the Allstate plan, but it becomes a voluntary offering to all of the other employees who were previously funded as well as a way to supplement what they have with the Unum plan, right?
Mhm.
So I think there are a number of kind of amicable solutions here, and you're right, Mark. It's because that Unum plan is portable, right? At the end of the day, if the employer wishes to move their funding or doesn't, it's a portable benefit. So the employees are not losing their benefit at the end of the day.
Yeah, and then you run into objection. They say, nope, I don't want to pay more premium. Just reduce the death benefit on the left-hand side to
Yep.
25,000.
Yep.
Just make it, make it a smaller benefit at the end of the day. Sorry, we're working on the calculator might be a little bit slow today. But you see that? I mean, like, you can actually price it lower too. Again, you're just reducing the amount of coverage that people are going to have going forward on this new plan. But again, they can keep their old plan. Now they're adding $1,500 a month to whatever they have, right? So I think that's also very easy to do, but I don't want you to necessarily undersell the client because I haven't run into as much rate sensitivity as you might think. because the
Agreed.
absolute pricing differences aren't a big deal for a company, like, even that has 20 employees paying $400 a month extra isn't necessarily the shock that a 40% health insurance increase has to them. Do you see what I'm saying? Like if you're increasing their health insurance costs 40%, that's probably thousands and thousands of dollars, tens of thousands of dollars maybe. When we're talking $400 total, it's a very different conversation when they think about just the absolute dollars and cents there. So don't get too caught up in the percentage if it's a small amount to begin with.
I totally agree with that. And the reason I gravitated toward 5% and 5% on the comparison is that many times I get the question, is this Allstate plan, is it possible? Is it sustainable to be priced at this level, given that we have guaranteed rates? So when I first started diving into the calculator, I looked at Allstate's 5%. I looked at the Unum plan for 5%, and I thought the results were pretty interesting to see where the Allstate plan was priced relative to the Unum plan that has room for rate increases. That
Mhm.
was something that I saw as interesting. I might not walk into a sale showing this, but if we wanted to, make monthly benefits as close as we could here, it's a very interesting sort of case study that we look to see that we've got things looking relatively equal from a pricing standpoint here, monthly benefit standpoint, um, and even just kind of showing what the plans would look like out of the box. You can set claim age equal to current age on this calculator and see how things are going to work right out of the box before any inflation.
Yeah, and the
Uh,
way I kind of prioritize it, because Jason, you're kind of hitting on a really big picture thing here, which is that 5% inflation with Allstate is super inexpensive.
yes,
Like I wanted to show that the term life with no inflation because that's just more widely available.
right.
But yeah, anytime you have a chance to use this product, you're going to win. We brought this in, and again, California clients is one of the bigger ways to get this. And they told us that the price that we were showing them versus another broker was one-fourth of the price when they were looking at this. Like it was like so different that it was such a no-brainer to go with this. And you're going to see that in a lot of different formats, even when you're not doing the Unum comparison, is in general, it's just hard to beat this. So priority wise, when I'm thinking about, where to position the products, if they have access to this, it's almost always number one.
Right.
Even when it comes to lower pricing, you can reduce the death benefit enough where you can make it whatever price range you want. We've seen this 3, 5, $10 a month, even with the 5%, because you're starting at such a low benefit that you can make it an inexpensive product. So the only objection has been like, oh, I'm looking at this and it looks more expensive, but they're not looking at how you can reduce the death benefit to make it inexpensive. Um, and then after this 5%, just big picture wise, those term products collectively, they're all going to be pretty competitive. The Allstate has the term, the Chubb, Trustmark. There's also about two or three other carriers that we don't cover right now in the buddy system here that have
Yep.
added this concept of term to 121 or term to 100 products. Those tend to be the number two most popular in the market because perception, people want to buy their long-term care on term. The fact they don't have that option in the individual market, right, with the term to 100 or term to 21 doesn't really exist on the individual market, and it just is delivering on that. How do I get an affordable long-term care easily? Value proposition that tends to fit the best. I would also put Transamerica's high face amount, like the minimum funded universal life, in that category. It's really priced similar to term when you look at that. So those are the kind of the ones that I almost always lead with after this 5% rider are the term products collectively. But the whole life too, with Allstate is also very good. Again, in context, it's got, rock solid guarantees. It's still very affordable again with how you do it. That tends to be a little bit lower on the list for me because if I have to choose between the term and the whole life to do that comparison, I think you're going to find, 75% of the time, 80% of the time, clients are going to go with the term option, just like they do with the individual market. Most individual consumers buy term versus whole life. I don't think you're going to see that big of a difference on the group side. But I
Yeah.
just wanted to like kind of give you a prioritization collectively because when you do those comparisons, it all kind of boils down to that same analysis, I think.
Yeah, I agree. And, I think one of the things that we have done a lot of is comparing on the monthly benefit amount, right, for long-term care. So when you're comparing a product with 6% acceleration to a product with a 4% acceleration, you may even on this calculator show death benefit amounts that are different but result in the same monthly long-term care access amount, right? That seems to be, from in our eyes, kind of that level ground comparison that you can make. And, Allstate Term Life really stands out in that sort of exercise, but also, even if I were to pull the whole life in here, it comes reasonably close to what we have for, say, a Chubb for larger groups.
Yeah, and just so you know, just to be kind of fair to the other carriers, Trustmark has come out with a 6%
Yep,
acceleration. I don't know if it's state specific. I don't have the exact details, but we've seen quotes with that. Chubb also, I believe, is launching their new product to have more acceleration options.
they are.
So they're all responding to each other, right? Based on this,
Yes.
to be competitive. So don't assume, okay, well, they're always better because of this. Actually make sure you do your homework
Yep.
to check on that.
That's the interesting thing that we're actually seeing when we start to really hone in on, all right, well, we're noticing some key differences or key advantages of other carriers here. It's like 1 to 2 weeks later, our wholesaler is telling us that changes are coming that kind of pull these guys back kind of neck and neck in what they offer. So it's a very kind of fast moving and competitive industry right now. So there's going to be a lot of changes even coming to this calculator
Yeah, and you can
going
do this
forward.
analysis too with the whole life and try
Yep.
that because I would say that's probably not on the right hand side,
Oh,
but more on
excuse
the
me.
left hand side. That comparison, yeah. Let's see if we refresh. You might have to change the age because I know it's slow a little bit right now.
Yeah, it's our poor child. We're putting it through its paces,
There we go.
so it needs some time to think.
So this is an interesting comparison because a lot of times if you just choose the same face amount, which is almost what almost every broker does, you're going to see, okay, the whole life is going to be higher than the term life,
Yeah, I'll show that really quick.
right? So maybe it's like, $40 a month, which would be what, 40, 50% higher price
Yep.
for the whole life versus the term life. Now go back to that 50,000 because now we're comparing them on the same monthly benefit. Completely different story, right? With how people perceive this. And if the concern is how much, LTC am I getting a monthly benefit, even the total benefits you'll see aren't that far off because Allstate does 100% restoration of the death benefit too. Like this is more important. Like the multiplier is not the be all end all, kind of coming back to that theme. But this is how we really think about positioning it. And you might say, I think actually this is a good answer to someone, I think David had asked a question in the chat about GI. Is GI available only during the first purchase? The carriers have different rules on that. Most of the time, you can do GI for multiple enrollment periods, actually. But they're all very different. Sometimes they say, like Chubb might say, you have to buy a minimum amount first to be guaranteed that you can get GI the next enrollment.
And only incremental
Yeah, it might
options
be
to buy up
limited.
from there.
And maybe Allstate might say, well, we're going to give you 3 years of GI right on the proposal. So you might say, well, because I'm getting that, I'd rather go with an Allstate option, or because of the customer service, or how comfortable I am with their process, I'm going to do that. I think that's also where you put this into your calculus and decide how do you want to position the carriers from that perspective too. It's not just about the leverage. So
100%. And now that I'm reading the chat, totally agree, Jackie. Even in individual planning, we have folks who are budget restricted and are happy to end up with anything in the individual market. And we have to think about those people. Those are the people who are really granted access to long-term care planning in some ways where they may not be able to otherwise, especially folks in the younger market who don't have largely an established savings, but still find this planning important for as their income and assets grow over time, right? So it's allowing us to reach a market of people that we may have had difficulty finding something for. And I think that's what this really helps to show, right? You can get to a plan that is affordable for most everyone who finds this important at the end of the day. And underwriting is not a roadblock.
Yeah. One other comparison, not group to group, but if you choose the Allstate whole life with the 5% again,
Hmm.
this one was very striking to me. And again, some of these, this is a relatively new tool, so you can
You want me
see
to
how this will.
show out of the box
Yeah,
again?
that's fine. Yeah, that's fine. But go to that's fine. Yeah, just leave it the
Okay.
way it is. But do instead of group product comparison, do individual life with LTC. This is pretty striking to me too.
Yes.
We had a lot of questions on the group side about, well, if I were to go to the individual market, surely I must get a lower price if it's fully underwritten.
Surely.
Not so surely. I won't use the airplane quote here, but 50% of the price of a group plan than an individual. Do I get a discount? Well, versus the individual market, this could be significant. Change the right-hand side to female, right? We know that it's going to be gender-specific pricing, might even be more striking. Well, let's look at traditional long-term care. Surely, traditional long-term care fully underwritten
Surely.
must be less expensive. Not necessarily, right? Especially for females. So you're starting to see big gaps, like in terms of value. And why is that happening? We probably talked about this a little bit in the past. What is the group side assuming? They're assuming most people drop their policies when they leave the company. They're not going to use that 5% growing product. You might, you might have the chills. I've seen this story play out before, but the reality of it is that's what their experience is showing, and they're reviewing that experience all the time. And I would expect that they will probably raise the pricing for new groups going forward on this plan design as they kind of review that year over year. But right now, you have a great value that has guaranteed premiums. You should lock that in. This is just another way to examine that. And this just takes away the client's objection when you say, yeah, go shop the market. And they come back and they're like, wow, you're right. I could not find anything as good as what
Mark,
you showed me.
can you speak to these group plans? Because I get this question every once in a while. Can you speak to their ability to actually um, cancel someone's coverage? I get questions about
Yeah.
non-cancelable, guaranteed renewable. How does this apply to these group plans? Like, if
Sure.
this plan is just completely underpriced and guaranteed premiums, can they rip somebody's policy out from underneath them?
Okay. Well, it all comes back to the contract, right? And this contract is whole life. Okay. So fundamentally, guaranteed premiums, guaranteed benefit structure. So that's good. It's a group contract. And so in the group contract, you have to look for what they'll call portability or continuation of coverage. And what that will say, again, you should look at the sample contracts, to kind of read this for yourself. It will say if the group discontinues the plan or the employee leaves the plan, you have the same contractual rights as you did when you were part of the group, including the premium doesn't change when you leave the group. Now, it's really important that clause because in other group products, those are not the guarantees that you have. In fact, with most group products, I would say that the rates are designed to increase if you port it, and the benefits do reduce, at a certain age. They're designed to be more temporary benefits. So most group brokers you talk to or HR you talk to will think that it does not have those guarantees, which is why you have to call it out and specifically say this is designed to be something that you need to keep, and here's why. And here's how we make sure that more people keep it because of how we educate, enroll, bill it with ACH billing. Those are all the ingredients that make sure, right, that people are going to exercise their options. But I will promise you this, and I'm seeing this even in the last week. I'm probably going to go off topic, but where you have to rely on the contract. You can't rely on a person at the carrier or a promise that someone made to you. Those people are going to be different in 30 years. I can almost guarantee it. So the buck stops with making sure that you have that sample contract and you get your questions answered if there's ambiguity there, and there will be. But we've reviewed these contracts and they're very solid from our perspective.
I would say not even just looking out 30 years. I would rely on the contract today, as opposed to a game of telephone, the result of a game of telephone, essentially.
Yeah,
Who is working with you on these products is not the same person as who built the product, who helped actually draft the contract, right? And
right,
the contract is the law. People can interpret it, right? But
right.
what's written in the contract is the law.
Yeah, and you have to also think about the incentives, and we've seen this already play out. This is not guesswork. We've seen what happens when an insurance company underprices their product, right? They're not incentivized anymore to give their customers, their brokers, good service. We're seeing that with some carriers on the traditional side. That's what I was referring to. I won't call people out right now, but a lot of complaints about certain carriers, right, that are not fulfilling their customer service obligations because the financial part of their business is struggling. And this with these group products, they're going to make that portability not as transparent. I can tell you that for sure. That's what's happening today. They have to do what's the minimum that's required by the regulator to notify people of their option there. You have to be there to service it so that they don't leave it when they intend to take it.
They're certainly not going to do a marketing campaign around portability.
Correct.
We do the marketing campaign around portability because we have incentive for people to buy, hold, utilize their benefit at the end of the
Right.
day.
And that's part of a big part of what we're investing in our platforms. It's how do we make sure that we can deliver the service that we're promising to our customers at the end of the day. And part of that is systematizing so we can do communications on what we advise the client to do, and they're getting those communications, at the right time when they need to take those actions. We can help as well when they need to file a claim, which we know is also, where the buck stops, and it's hard to predict how good service you're going to get. But if you're owning that responsibility, and we do it, working with firms like Amada Senior Care, right, to have them be our concierge claims filing provider. It could be someone who knows in 30 years, but we want to always have that service available because they're not going to necessarily be incentivized to make that as good of experience as they should. Maybe that's the cynic coming out of me because we see a lot of it. I've been in this industry too long, guys. I've become very cynical, but I think if
Well,
you can own
Mark,
that, you'll have a good outcome.
I think most people on this call are long-term care specialists or only juggle maybe a couple of other different products. And, based on everybody's experiences, they know and have been hardened to the fact that you got to be a bulldog to really make good outcomes in the long-term care market. And that includes getting the right answers, understanding the contracts, and making sure you're advocating for things that carriers don't have incentive to advocate for because that's just all in the nature of clients being helped by these plans, right? That's why we're here.
Well put.
Now that we have now that we've gotten down from our soapbox, do we do we have any other comparisons that you think are really, really illuminating? Oh, Jackie had a question. Would you ever offer two different carriers at the same time? That's a super good question.
It is. I would say with group plans, if you're offering it to new participants, the group carriers really won't allow you
Yep.
to offer two group plans at the same time. Even within carriers, like Allstate has whole life and term life, you can't offer both of those life products at the same time. You have to choose one or the other. For a number of reasons, but I think that's probably a best practice anyway, because you want to keep it simple. It's hard enough to educate on one of these products. I'll give Gretchen a stroke if we try to do enrollment for two products at the same time here when we do our enrollments. So it really is important to keep it simple for everyone involved, because again, the purpose of that is different. Now, where you might stack coverage, because again, we've talked a lot about stacking coverage, is people that own a policy already. You can add this right as an additional policy to that. People
Or
that want to add
supplement.
Yeah, people that want to add an individual policy, you can add that. People that are moving over from a different group plan, you can add this product. There are going to be nuances like replacement questions that you have to ask, or certain questions the carriers ask on the application. So just be aware of the process there. But fundamentally, these are, don't coordinate benefits, and we do like the idea that you're buying a little bit, but you can add to that and you can claim on both policies. And we like the diversification that that provides. So that's kind of the long and short of it. Is focus on one, but don't be afraid to offer this in addition to something else like that they already have.
Can I ask a question?
Yes, you may.
Um, uh, GI is generally available on the first purchase, right? And then new employees can receive GI on the first offering. Are there any other GI exceptions?
Yeah.
Yeah, it's going to vary carrier to carrier, and it's going to vary group to group within each carrier's sort of perspective.
Yeah, here's
So,
what we've seen is if you get on the proposal, you can get multiple GI periods approved with certain carriers right in the proposal. So that will be obviously multiple GI for everyone involved. Some of the carriers obviously do GI for spouses as well, some don't. So that's another variation on this. But here's what happens over time is you get a certain experience, like participation wise, with your enrollment. And if you have a good enrollment and you go back to that carrier and you say, hey, can I have another GI? They're much more likely to grant that for you, even after the fact, because they're not worried about hitting that minimum. So the minimum that you see, like on those proposals for participation, think about, is it realistic that you can hit that participation for each enrollment you want to do? Let's say with an Allstate, the minimum is six. If you can get six apps for that enrollment, usually they'll approve it. And where they're going to be uncomfortable is when you don't hit the six, right? Their original minimum. But you can do that. You could potentially do that over and over again, and they would still be happy, just like if it was a new group. That's
Hmm.
that's how I've perceived their temperature. Whereas you have a Chubb, which might have a higher minimum participation of like 10 or 15%, and they only look at groups, that are 100, 200 plus. Well, now you have to have 10 or 15 or 40 each enrollment. And is that realistic to do? Might be a little bit tougher as a percentage on a percentage basis. But that's really what they're looking at is it's not about you can't do GI in the future. It's more about we'll evaluate situation by situation and you can't anticipate whether you're going to get it in advance. So you have to
Hmm.
just basically say, this is your special period. We can't guarantee that we'll get this for you again, but we'll ask. And if you really are motivated to educate people and, promote this again, we can usually get that approved because we have a good reason for doing it. But some brokers just don't put in the effort to do that for these benefits. So their experience has been poor when they've seen a second enrollment, and they just throw it on the shelf. They're going to have a tendency to decline unless you have a good reason to say, hey, we have a good access right now for this reason.
yep. And you've seen in enrollments that we've done, depending on the group size, the group demographics, beyond just what each carrier thinks of it. We've seen all different shapes and sizes, and we're continuing to see all different shapes and sizes of, hey, it's got to be a 30-day GI. But I've also seen a proposal come back recently that says, hey, we've got, one GI period here, but we'll actually give a couple other 30-day GI periods at their next two annual enrollments. You've seen enrollments we've done that has said take the whole year as your
Yeah.
GI period window, and we're still going through that exercise quite a bit of understanding what is actually best for our groups. Sometimes we see a year-long guaranteed issue period, and right off the on paper you say that's great, and then you get through the enrollment, you have kind of an initial surge, and then you have a bit of stagnation because I can just wait until the very end of the year to enroll for something. You wonder, is that actually in the best interest of everybody, or is shortening up the window,
Yeah.
actually the best fit? And is multiple shortened windows actually the best? So it's still a lot of like trial and error, but it's all carrier discretion at the, but it doesn't hurt to ask, essentially.
Right.
Yeah. I think David had a follow-up, and maybe Jackie too, about On the second offering, can existing clients increase their coverage to help meet a minimum? The reality of it is they're really looking for new employees that are added, but in practice, they might only see an application from an employee. So I don't know if they're kind of counting it that carefully. I think they're just trying to make sure that you're at least in the right ballpark compared to the minimum. Because they have discretion to waive that. The only thing that they don't have discretion on is if there's like a regulatory minimum. But again, it's usually like at least two to be okay with a group. And some carriers might say there's a 10-person minimum for certain types of groups. So they want to at least hit that. Otherwise, they can't offer it. They're not supposed to offer it. I think the risk side is interesting because the carriers probably should be more concerned about that, but because they're not seeing claims, these
Super
things
good
take a
point.
long time to develop claims. They're more concerned about mortality risk, like having this big death claim, 6 months after someone buys the policy, right after their pre-existing condition limitation ends. Now you pay out $100,000. That's going to take a lot of premium to take that risk. So that's what's more important to them, I think, is that piece of it. What they're really looking at with minimums, from what we see, is a lot of times it's the operational cost for the company. They're very kind of manual in some of their processes, and they put a lot of like their team's time, the internal carriers team's time in doing these enrollments. So they're more concerned about, well, if I'm going to get, 6 applications and I have 10 people assigned to this account, does that make any business sense to do that? So we try to make it more efficient, but at the end of the day, they have their own process. There's a lot of checks and balances. So that's really what's limiting you more on the minimum participation is why are we doing all this work to get so little results? It's actually the same rationale you should have and the client should have is why are you spending all this time if it's not the right condition?
100%. I think you hear carriers valuing different things as well, depending on the carrier or depending on the case itself. Sometimes you think it's all about just new employee belly buttons as far as participation goes, but then you can have a case that does really, really well on premium, and it's like, did the belly buttons even matter at the end of the day, right? So all shapes and sizes, and I think the carrier is generally going to do kind of a broad reaching analysis of an enrollment when it's done and say, was that good or bad, and what were the reasons?
Yeah. Yeah, and it's about incentives there too, right? If you do a lot of premium, regardless of how many cases you do, your sales wholesaler is going to be really happy and is going to fight for you
Yep.
because that's how they get incentivized, right? That's how their compensation is determined too. So, average premium per policy matters here. Some carriers are like, bring it on, like high average premiums are good. Some carriers, get a little bit more nervous about that because they're worried about that individual risk,
Spread of risk,
spread
right.
of risk. Yeah.
If you're getting a lot of premium and it comes from risky business, some carriers may say, yeah, it won't play out until potentially later on, but you got to be able to look forward in some of those cases too.
Right.
Jackie asked, are group carriers restrictive on how many plans you have, even understanding the replacement questions? We're still working with the carriers on this piece. They are required to ask questions about replacement, but the process that follows or existing coverage even. So the process in particularly enrollment platforms that follow a yes answer to this question are still kind of being worked out.
Yeah, they're
Uh,
not they're not doing things like the individual carriers do where they say you have a maximum amount you can get across all of your policies, right? So that might be, something that comes to mind for those of us that deal with that a lot. Um, they don't want you though kind of gaming the system. Like how you might buy like, oh, I can't get that total amount of life insurance coverage, so I'm going to buy instead of $1 million, I'm going to buy five $200,000 policies from 5 different carriers. You don't see that happening, and I think that that's probably not a good path to go down. It's just not going to fit the group market. But if it happens kind of as part of a takeover, that is a part of the group process. It's very common to move benefits from one carrier to another because they have a better offering or what have you, or broker of record change. So they're not going to really be skeptical if you're just adding another plan because the group had one already. They actually want those opportunities, right? Because they're looking to compete for that business. You just shouldn't be like trying to do that, intentionally just to get one person higher than the total amount of coverage they could get.
I think that's a good answer. And we're right near the top of the hour. That went by in like the blink of an eye. I hope you at least enjoyed the introduction to the side-by-side um, group product comparison. There's a ton you can learn by just going in there and playing around with the different plan designs. But as I might have said before on a study group or two, we are also working to have kind of state-specific filters. So you'll be able to, in the future, add a state to Group Quick Quote, and plan designs that don't matter to your state, aren't available in your state, will fall away to kind of be able to organize your thinking a little bit. And then also by size segment. A number of different things change based on size segment. So we're, beyond all the changes we've made, beyond adding more plan designs, we'll continue to allow Group Quick Quote to organize your thinking a little bit more based on a specific group you have in mind. So there's a lot more to come on that tool. We're really excited about it, and it's only going to continue to get better from here. Anything you want to add, Mark, to this?
No, thanks for all the support, everyone in the group. As usual, give us your feedback. Give us
Yes.
sample quotes you want to add to the quick quote, right? There's an infinite number of quotes and carriers, and it's growing every day. So don't be shy about letting us know where you see opportunities because we'll be happy to add them for you.
Yep. Alrighty, that'll do it. Thanks, everyone. Be well. And let me reshare the if you would like to share the annual market review on January 8th with anyone. You guys don't have to do anything if you want to come, just show up January 8th to this same link. But if you want to share that out to anybody in your network, feel free to do that. The piercing light is in my eye again, so that's signaling to me that the study group is over. Thank you all for being here. Be well. We'll talk to you this time next week. Have a good one.